Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning and a warm welcome to Money Talk on the final day of the week. This is Peter Lewis. We're currently one of the top-ranked finance and investment podcasts on Apple Podcasts in Hong Kong, so thank you for listening. We're also on Google Podcasts and Spotify, and if you go to peterlewismoneytalk.substack.com, you'll also find my daily newsletter, which contains a lot more business and finance information to go with this programme. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. Here are the business and finance headlines for Friday, the 2nd of June. US Senate's Majority Leader Chuck Schumer is racing to push the debt ceiling bill through the upper house of Congress by the weekend. Mr. Schumer said Thursday the Senate would stay in session until the bill was approved to stave off a historic US default. China's factory activity rose above the 50 mark that separates growth and contraction in May, a private survey showed on Thursday. The Caixin China General Manufacturing PMI unexpectedly rose to 50.9 in May from 49.5 in April. Outputs rose the most in 11 months. New order growth was at a 2-year high, and foreign sales continued to increase. However, employment fell at the steepest pace since February 2020. Retail sales in Hong Kong grew 15% in April from a year ago, marking the third straight month of double-digit growth. Retail sales grew by 21.7% in the first 4 months of this year, compared to the same period in 2022. The increase was driven by a 75% jump in sales of jewellery, watches and clocks. The US and Taiwan signed a new trade deal on Thursday under a framework for talks between Washington and Taipei called the US-Taiwan Initiative on 21st Century Trade. The framework aims to strengthen economic ties between Washington and Taipei and open Taiwan to more US exports. On today's programme, I'm joined by Francis Lun, the CEO of Securities, and John Schofield, Managing Director of Tempus Investment. And with a view from Australia is Toby Lawson, Director at Statton Advice.
Peter Lewis's Money Talk.
US stocks closed higher Thursday on debt ceiling optimism and falling labour costs ahead of today's jobs report. Stocks rallied throughout the session after the US House passed the debt ceiling bill, and it's largely expected to pass through the Senate as well. Equities were also supported by a Bureau of Labour Statistics survey, which showed unit labour costs falling to 4.2% from 6.3% a month ago, along with a soft ISM manufacturing survey. Both the Nasdaq and the S&P 500 closed at their highest levels since August. The S&P 500 gained 1% to finish at 4,221. The Dow traded up 153 points, or 0.5%, to end at 33,062. The Nasdaq Composite added 1.3% to end at 13,101, and the Nasdaq is up nearly 1% week to date, putting the index on track for 6 straight weekly wins. That's a streak not seen since January 2020. US Treasury bonds rallied as Fed officials continued to push the idea of a pause in rate hikes this month. The yield on 2-year notes fell 5 basis points to 4.34%. The 10-year yield dropped 4 basis points to 3.6%. Hong Kong's Hang Seng Index fell 17 points, or 0.1%, close to a 6-month low of 18,217. The city's benchmark index is just 1% away from falling into a bear market, defined as a drop of 20% or more from its recent peak. Futures markets are predicting a strong start for the Hang Seng this morning with a gain of 350 points. That's 1.9%. Mainland Chinese markets were flat with the Shanghai Composite at 3,205. Elsewhere in the markets, the US dollar index fell 0.6% to a weekly low. Brent crude oil settled 2.3% higher at $74.28 a barrel, and gold futures rallied, briefly topping $2,000 an ounce intraday. You can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk.
Peter Lewis's Money Talk.
Talk.
Welcome our Friday morning guests. We have with us Francis Lund, the CEO of Securities. Morning, Francis.
Morning.
And also with us is John Schofield, who is Managing Director of Tempus Investment. Morning to you, John.
Yes, hello, good morning, Peter.
Now, China's factory activity rose above the 50 mark that separates growth and contraction in May, a private survey showed yesterday. The Caixin China General Manufacturing PMI unexpectedly rose to 50.9 in May from 49.5 in April. Outputs rose the most in 11 months. New order growth was at a two-year high, and foreign sales continued to increase. However, employment fell at the steepest pace since February 2020, and sentiment slipped to a 7-month low with lingering uncertainty, particularly from overseas. Now, those figures contrasted with official figures Wednesday that showed a further contraction in activity among larger state-owned enterprises. So, Francis, what do you make of this divergence?
Well, I think the smaller enterprises are doing much better than the state-owned enterprises. I think what the figures tells us, and also that the economy is staging a uneven recovery, and I think still. The government tried to drive up consumption to boost the economy, but I think in this respect they are not really achieving their goal. And of course, the Caixin PMI showing growth is a good sign because that shows the export sales are improving, especially for the small manufacturers. So it's a mixed picture, but still it's better than everything's dropping like a rock.
This is a combination, I think, of the cyclical forces and also the secular issues that China faces, and we happen to have bad news on both fronts recently, particularly commodity prices sliding. Employment is declining, and there's also it's right that sales are picking up, but at a cost. There's an awful lot of discounting going on. There's a price war in the the pivotal solar panel business, for example, which is very destructive of shareholder value. Mm.
Well, Francis, you mentioned that the government is trying to boost consumption. Yeah. What they seem to be doing is talking up consumpment, but not actually enacting any policies to go and boost consumption.
Yeah, that's definitely true. I think they should follow what Hong Kong did. Is giving everybody $5,000 consumption voucher and they spend it. That throws something like 30 billion Hong Kong dollars into the retail economy. I think it is what the economy said. They're throwing money from the helicopter, and if you have your domestic demand is lacking, so give people some money, let them spend, and they will boost the economy. And I think the policymakers in China just haven't been decisive enough. They are letting the economy slowly sink, and that is not a good sign. I think the Premier Li Qiang has to do a better job.
You're the second commentator this week on this programme to say consumption vouchers are needed to try and boost consumption. John, are you going to be the third one? Would you concur with that?
I don't feel qualified to talk about that really in the context of mainland China. But do
you think that works here?
What I would say, I think so. I think it helps. Every little helps. It's just. I think the problem in China is you've got to get the feel-good factor back somehow. And, despite the reopening after COVID, I don't think it's really back yet.
You can't get the feel-good factor back when over 20% of youth under 24 are unemployed. That's going to be tough, isn't it?
Absolutely. So we've got to find ways of stimulating the right kind of industries, rather than property. Forget it.
They're asking They're asking the young people to go back to the field and then farm and produce more corn and soybeans, so that China does not have to rely on the U.S. for soybeans.
This is not what common prosperity was supposed to look like, is it? Sending qualified graduates back to work on the farms in their villages.
Back to the 60s, 50s and 60s.
So what would you both like to see then the government do to try and boost the economy? It seems to be quite widely accepted that economic growth on the mainland is disappointing at the moment. So although there has been a rebound since it reopened, it hasn't been anything like what people were maybe expecting at the beginning of the year. And there's signs, as you mentioned, Francis, of it being an uneven recovery. Services are doing better than manufacturing. What would you both like to see the government do to try and rectify that? Concrete policies that they could take rather than just talking?
Yeah, for decades, the government has been depending on fixed asset investment as a driver of the economy, but it has not worked now because the real estate market has cratered. And all over China, there are still many unsold flats, so they cannot use just build buildings to boost the economy. And for the manufacturing sector, global demand for consumer goods are falling, despite the fact that China has become the number one car exporters in the world now. That's really surprised me. It just surpassed Japan to become the biggest car exporters. But other than that, but for other manufacturing goods, I think demand is lacking, so you're left with the only thing in the economy which is consumption. So I just mentioned before that just give people some money to boost the economy. Otherwise, other than that, I don't know. I hope the government has better policy thinkers.
But the problem is, you can't just rely on exports, can you? And particularly if the US slows and slips into recession, then China's going to be hit badly. It's got to have other things. But the risk, I presume, is that it just slips back into the old ways, which is infrastructure investment, building more roads and railways and bridges. That seems to be, in the past, the easy thing for it to do.
But that's counterproductive, because when you talk about the high-speed railways, I think only 3 or 4 are profitable. The rest are all losing money. It's a severe cash drain on the economy.
John, what would you recommend the government do if you could sit down with Li Chang and talk him through some of the policies? What would you say?
Well, I think they need to revisit this. Crackdown, if you like, on the private sector, particularly in the technology areas. I mean, this is where we see it every day now. This is where U.S. economy is really, really coming back very strongly, driven by the new wave of technology. And I don't think China can achieve it through, diktat, by instructing semiconductor companies to innovate. You've got to unleash the people's creative powers. I don't know exactly how you go about that, but I think the Alibabas and the JD.coms and all these other companies ought to be the engines that are driving increased consumer consumption and so on.
What was interesting was Jamie Dimon is in Shanghai at the moment for a JP Morgan banking conference, and he warned yesterday that uncertainty over the Chinese government's policies could hit investor confidence. He told Bloomberg TV in response to a question on China's crackdown on the tech sector and on consultants, if you have more uncertainty, somewhat caused by the Chinese government, it's not just going to change foreign direct investment, it's going to change the people here and their own confidence. Now, this is interesting because he's really quite laying the blame for the economic woes at the door of the Chinese government. And now, I suppose if anyone else said that, they wouldn't get away with it. But it is Jamie Dimon. But is he right?
That was the point I was just making, except he makes it far more eloquently than I did. That's for sure. Yes, forgotten about that. I mean, the consultant. I mean, talk about sending mixed signals. How can you? As I understand it, the consulting industry is basically the Sherpas for foreign investors looking to come into China. Doing the due diligence on the ground and advising how to do so. In a as risk-free manner as possible, or lower risk manner as possible. I mean, if you just decide that's off limits, then how on earth are you going to attract foreign investment?
Mm. Yeah, well, the tech sector has been a driver for the economy for the past decade, actually. Alibaba and Tencent, all these companies hiring tens of thousands of fresh graduates every year. Now they're firing people. That's why you have 20% unemployment on the youth. So if you don't have people hiring people, how can your economy improve? I think this crackdown on big tech has gone too far too much, and it has hurt the economy now. I think right now is the right path is for the government to reverse course and then try to help the big techs to restore confidence so that they can hire people, they can go back on the expansion trail again.
Do you think the government is getting that message? It seems to send mixed signals, doesn't it? Because the Premier seems to be business-friendly, but this week President Xi Jinping has just talked more about national security and how much the Communist Party must dominate everything in China, but nothing about the economy, nothing about youth unemployment.
Yeah, definitely. The Communist Party is more important than your parents.
So it's not going to get the message then in that case by the sounds of it, and even if Jamie Dimon's right, it may be falling on deaf ears, that message.
Certainly.
Let me turn to the equity markets in Asia and how they performed in May. There was a big theme, wasn't there, in May, which was a decoupling of the major Asian markets away from China. Equity markets in Japan, South Korea, Taiwan, India all put in a strong performance in the month of May, and that's attracted the attention of global investors, while Chinese stocks flirted with a bear market. Japan was the month's standout performer. The index was up 7% overall in May. South Korea's Kospi put in a positive performance over the month, rising 3% in May. The Taiwan Stock Exchange weighted index rose 6% over the month, and Korea and Taiwan have netted at least $9.1 billion each this year, which is reversing outflows from last year. And also in India, foreign funds have helped drive the Nifty 50 index to less than 2% away from an all-time high. So first of all, let me ask you about these other Asian markets away from China. Why suddenly all this attention on particularly Japan, South Korea, Taiwan and India?
Well, I think this is basically the U.S. initiative to gather the democratic countries in Asia into an alliance, at least an economic alliance with the U.S., so that they help each other's economy, and especially for Japan. The Japanese market has soared to a 33-year high. Wow, that is
back
really
to 1990. That was when I was living in Japan in those days. That's how long ago it is.
So still, China is still mired in recession because of the severe lockdown due to the COVID crisis. I think China will take some time to recover.
John, how do you explain the performance? Is it something to do with particularly countries like Korea and Taiwan? They're obviously they have some of the world's leading chip makers there, and that's been a big theme, hasn't it, for almost all year?
I mean, that's certainly one factor. But to some extent, it's just the flip side of money flowing out of China, where they're going to put it, and those are the obvious. I mean, India has been the darling of emerging market investors for quite some time. Actually, I mean, it's been going sideways in recent months, but it looks as though it's going to take off again. The Japan thing is obviously the most intriguing, but because there's a sort of confluence of factors there, but primarily because there's people perceive there's a lot of value in Japan. The stocks are still very cheap, and that's because corporate governance in Japan has not been suitable for Western investors for some time, but that's changing. They're certainly getting, even though you don't have rapid growth, certainly in the domestic market in Japan, there's plenty of room to get more cash out of the great majority of Japanese industrial companies, and don't forget they do have a second to the US, really, a very powerful array of manufacturers in all these new technology areas.
And of course, inflation is back in Japan, which traditionally is actually good for equities, isn't it?
Yes, because they used to simply translate earnings, the dollar earnings overseas into yen, and if the yen is weaker, then obviously, as it has been, that's the other factor to bear in mind, of course. If you're unhedged, you haven't made anything like the gains you've made in yen terms by investing there. But I think that's the Japan is still a very high has a very high level of government debt. Highest in the world by far, and you see Americans arguing about having just over 100%, I think it is, when Japan it's double that. So inevitably there'll have to be a change in monetary policy. They're obviously being very, very cautious about how to do that, because the cost of much higher interest burden on government debt is something to be borne in mind.
Do you think, Francis, last year, if you weren't in China, really, it was hard to find anywhere else in Asia to go. But right now, there seems to be a number of attractive alternatives. Japan has finally taken off. Some other markets have caught fire as well. Is that one of the reasons why Chinese equities are doing so badly, that it's those markets are sucking money out of China?
Yeah, definitely. I think the zero COVID policy really damaged China's reputation among the business world, and all of a sudden you cannot produce anything from China, because China has been the factory for the world for consumer goods, and now you have such a dramatic stop in 2022. So I think naturally the multinationals will start thinking to move some production out of China, and that has a rippling effect, and it has rippled through the economy in that production is down and then employment is down. I think China will really have to do a lot of things to restore the manufacturers' confidence, like Apple moving part of their production to India. Now it's difficult to get Apple to move the production back, because they already done so.
So this is irreversible, really, and it's going to increase, isn't it? Apple's already talking about more production in places like Vietnam and India as well, so this is not going to go in reverse. But is the worst over? Do you think the bad news is now fully priced in?
We hope so. Otherwise, we won't be doing any business in the equity market. We'll be sitting for dead phones every day.
My guess is that probably we're yet to see the sort of final capitulation sell-off, and I think that, but it should happen within the next. Say by the start of the fourth quarter, seasonally, typically we would expect to see some sort of upturn. That might be something to watch on. Just on the Apple, I did read something today that Apple is actually going to expand its sales network in China, and is opening a lot of new shops in various places. So to me, that's China has failed so far really to move on to the next stage of economic development, which is from being manufacture and fixed asset investment oriented to consumption. I mean, the percentage of consumption consumption as a percentage of GDP is still far, far lower than the West.
So what's the catalyst going to be that will get foreign investors back? Because they've been pulling out, and a lot of them have said to me they just can't see a reason to be in China at the moment. What could be the catalyst that would change their minds and say, OK, now is a good reason to start reinvesting in Chinese stocks?
Well, that's a difficult thing to do because all these things really is caused from the top, from the central government, the institutes, to the policy that's really put a premium on security and loyalty, and then you don't give the big tech companies the free rein to do whatever they want. Then you only have a command economy. You don't have free market forces working. I think the first thing the government need to do is let the market run do the things themselves instead of regulating, and then have the visible hand. Withdraw the visible hand of the government from the businesses.
I mean, John, one of the differences between Japan and China in terms of markets is in Japan there's been a change recently to try and focus on shareholder value. The government's been pushing it. The Tokyo Stock Exchange has been naming and shaming companies that hoard cash. So as a result, they've started to do share buybacks, pay higher dividends. Whereas in contrast, I think it's fair to say in China, the Xi Jinping government isn't particularly concerned about enhancing shareholder value, and they certainly don't like the idea of profits being paid back to shareholders. If that was to change, could that be maybe a catalyst? But it is a stark difference, isn't it, that maybe could explain some of the difference in performance?
Yes, I mean, it's been a long time coming in Japan. People have been, hammering away at that for a long time with these activist funds and so on. But finally, yes, as you say, a consensus has emerged in Japan that this is the right way to go, and as it coincides with some other factors, and that's why we have a nice bull market going on there. China, as I say, it's hard to say what would be the catalyst, but I mean, you have a stock market sell-off, and then which happens to coincide with some sort of pivotal event. I don't know. I mean, perhaps a new agreement with the US or something like that, a new approach.
Well, that's one of the things that foreign investors are saying is a deterrent for them, these geopolitical tensions.
Yes, clearly. Well, as Francis has just laid out, all these the difference. We now see very, very stark and very clearly the difference between a top-down command economy and a bottom-up entrepreneurial capitalist led economy.
Do you think, Francis, that it could happen? Do you think there could be a focus on enhancing shareholder value in China?
Don't hold your breath on it. but if you look at the financial firms like the banks, insurance companies, they pay good dividend, except that the prices don't really go up at all.
Yeah.
There has been this boost to state-owned companies, hasn't there, in the markets? The government's been trying to promote banks and other state-owned firms, but presumably that's only got a short shelf life.
Yeah, that's right.
Well, thank you both very much. Great to hear your thoughts. Have a good weekend. That was Francis Lun, who's the CEO of GEO Securities. John Schofield, who is Managing Director at Tempus Investments.
Peter Lewis's Money Talk.
I'm joined now by Toby Lawson, who is Director at Statton Advice down in Australia. Morning, Toby.
Yeah, good morning, Peter.
Let's start with Australia, because there was some inflation data out this week. Consumer prices rose by more than expected in April. The monthly consumer price index rose 6.8% compared with 6.3% in the previous month, and market forecasts of 6.4%. I get the feeling that the Reserve Bank of Australia is being twisted and turned at the moment. On the one hand, it's signalling a pause because it thinks inflation may have peaked, and then you get data like this which suggests not yet. That's too early.
Yeah, it reminded me of a little bit of, for those listeners out there who know cricket, and I don't want to draw too much of an inference to cricket, but often when you're batting with a partner in cricket, it's often yes, no, wait. When you're looking to take a run, and often you can get run out when you get those communications. So a bit like the Reserve Bank at the moment are on a bit of a yes, no, wait when it comes to rate hikes. They paused in April, then hiked in May. And now the inflation figure at 6.8% which is above the 6.3% on a year-on-year basis, is well too lofty for them to be able to ignore it. But at the same time, they might try and pause on the basis that some of the other data that they're seeing is flat, like retail sales being flat for the month. And so, we're in that yes, no, wait type scenario. One of the things about the inflation number that should be noted is that there was an impact of the auto fuel excise tax, and that had a big impact in the previous April. So the base effect of that coming out probably pushed the inflation number up a bit higher. But still, even in an underlying basis, it's very, very much too high for the Reserve Bank when you've got a 2 to 3% target over the medium term. It almost forces them into making another move next week.
And I suppose a lot depends also on what the Fed does, doesn't it? And they're also in a tricky position. They're also being pushed and pulled in different directions because the data, on one hand, starts to suggest maybe things are stabilising a bit, and then you get another piece of data like we had with the JOLT survey this week, which suggests the labour market is still tight and there's still wage pressures there.
Yeah, and we'll see that tonight, I guess, with the non-farm payrolls to see how those numbers come out in the US. Actually, we're having the discussion this morning about, the likelihood that it's possible next week that the Australian rates will go up and the Fed will pause, which may be not priced in as significantly vis-a-vis the currency. So, looking for trading ideas, we're thinking, well, maybe the Aussie gets a bit of a bounce on the basis that the Reserve Bank might be likely to hike and the Fed could pause. Having said that, it's a tricky time because the Fed may still feel the need, given that some of the employment data is still strong, to hike. Whereas if you look at the Purchasing Managers Index and the Economic Activity Indexes, and I look at the ISM last night out of the US and also the Chicago PMIs, they're really weak. So it's possible the Fed are seeing the opportunity now to pause and see what happens. Whereas in Australia, the Reserve Bank may be forced into moving because inflation's so sticky. And
if you listen to these Fed speakers, the message they seem to be giving is that even if there is a pause this month, it's not the end of rate hikes. There could well be more to come later on in the year.
Yeah, and if you have a look at the futures curves, there's still some out to next year looking at rate cuts. And I think if one area of the curve you probably ought to be considering in terms of futures markets is that even if they pause, I can't see rates coming off in a hurry unless there is a big decline in economic activity and therefore a deflationary impact of that, much more aggressive than what the market is probably perceiving and what the data is suggesting. So, it's a tricky time, I think, to see what the Fed will do, and it's going to be interesting, that decision, and also here in Australia what the Reserve Bank do next week.
And is that going to be the focus now of investors, now that these debt ceiling discussions seem to be fading into the background? People are hoping that the Senate's going to pass this bill by the weekend. The focus now is very much going to be on the economic data and on the Fed and whether or not we're going to see further rate hikes this year.
Yeah, I think that's a fair point. And have a look at volatility. Went to 18-month lows overnight because the debt ceiling is off the table. That was trending down prior to the debt ceiling becoming an issue. You've also seen bond yields go 20 basis points weaker post this week after squeezing up into that concern. So that comes off the table. Now we get back to economic data. Now we get back to the Fed. We're going into the summer months in the Northern Hemisphere. That adds another factor where we'll see lighter activity, but potentially more volatility on the basis that liquidity is not going to be there. So, it's an interesting time coming up.
Okay, well, let me turn to another country that you know very well, India, your former home. We had GDP data out from India, grew much faster than expected, the economy, in the first quarter. It expanded 6.1% year on year. That's higher than an upwardly revised 4.5% in the fourth quarter of 2022, well above market forecasts of 5%. And then for the fiscal year, which did end at the end of March, India's GDP grew 7.2%. That was actually slower than the previous year's expansion of more than 9%, but nevertheless still beat economists' expectations. I mean, Toby, India, the economy there, it really is outperforming, isn't it?
Yeah, and interestingly, it's a function of a lot of the last 10 years of reform that's come through India, and some of the benefits of that starting to flow through. A huge amount of government expenditure in terms of driving infrastructure, and then private capital's coming in behind that to create some momentum. I think on the private consumption level, India is still a little sluggish, and there's potential for that to pick up. So if you look at I think yesterday they had the global S&P global PMI, manufacturing PMI for India was at 58.7. We'll compare that to the US ISM at 46 and the Chicago PMI at 40, and China just getting maybe just over the line at 50. On India's well ahead of the race in terms of activity, and I think it's structural to a large extent and likely to continue. There's some real tailwinds for India. It's not going to be simple because it's a massive country. Still a lot of difficulties around managing that economy, but a lot more tailwinds than headwinds, you'd have to say.
And it's attracting the attention of foreign investors, particularly because of that point you make about consumption. There seems to be a lot of potential, doesn't there, for a pick-up in consumption, and also consumers are moving up the value chain as well. They're buying, more higher-end end products. That presumably could be a big driver of the economy going forward.
Well, I think if you look at some key tailwinds over the medium term in India, manufacturing will increase as a percentage of GDP, which is important, not for jobs but also for the economy. Exports will grow at a higher rate in terms of market share to the world. Consumption, as you mentioned, will shift as incomes rise, so consumption patterns will change. Inflation will become less volatile. India's always had high inflation, 6% is fairly normal for them. But with interest rates at inflation around 5%, interest rates at 6.5, you've still got real positive interest rates versus negative interest rates elsewhere. So I think the cycles will be less volatile as you go forward, as the economy matures. And then over time, they'll be less reliant upon the major import, and the major risk for them is oil. As they develop more renewables, as they develop more capacity in onshore capability of energy generation, that's another tailwind that will, emerge over the next decade or so. So when I mention tailwinds, they're the sort of tailwinds that India has, and notwithstanding that there's political risk and notwithstanding that there's all sorts of other risks associated with India because it's a large democracy, you've got to say that, on balance, you're more inclined to back India than not.
And let me ask you then about the markets. There's been, I would say, two big themes, haven't there, in the month of May markets. Firstly, out here, actually, which is sort of the decoupling of some major Asian equity markets from China. Foreign investors have been selling China virtually, they forced some of the indices into bear markets out here. And instead of looking at markets like Japan, South Korea, Taiwan, and India as well. India's only, the Nifty 50, only about 2% away from an all-time high. The Kospi in South Korea is back in a bull market. In Japan, we're back to 1990 highs. But at the same time, you look at the Hang Seng, just 1% away from being in a bear market. And the H-share index of Chinese listed stocks here in the city is already in a bear market. What's driving that? Because it's very noticeable, isn't it now, the difference in performance between China and some of these other Asian markets?
Yeah, I think there's just a level of concern that China's not getting the bounce post-COVID that the market had priced. If you look at the main indicators, they've certainly got some, but they haven't really ripped out of it like a lot of other countries did with that pent-up demand coming and flowing through to economic activity. So I guess that's the hangover, if you will, of a much deeper, longer COVID restriction. The expectation was that, there is indications it's emerging, but it's not driving out. There's not the expected rush of activity and demand and spending that maybe we all expected once China lifted its restrictions. And I think that's probably reflected in the way the market's pricing, not only China but also, obviously Hong Kong. I suspect that's the main driver of it, and they're concerned that China's not going to get the big bounce that everyone expected. Maybe it'll just take a little longer because they were much deeper in the weeds when it came to the COVID restrictions for much longer. So possibly that'll just take a little bit more to get the momentum.
And presumably, if you're a foreign investor in China and you're one of those that's been pulling out and selling, suddenly you have some alternatives in the region. I mean, Japan has suddenly caught fire, hasn't it? Whereas it's been in the doldrums for just years. There's been plenty of false dawns in Japan that haven't really worked out. But maybe this time it feels like it might be different because you've got inflation coming back. You've got the government focusing on shareholder value, trying to get companies to pay higher dividends and do share buybacks. This seems to be noticed now, and of course you have the Warren Buffett effect as well.
Yeah, I think in that sense, I think Japan, I would have thought that maybe a year ago people were worried about Japan in terms of, failing to get that escape velocity from its, 20-year deflationary environment, but it seems to have kicked a bit now, and as you said, there's good signs in relation to that escape velocity that they've been looking for, and investors are jumping in on that. Still not quite convinced, but a little way to go there. But you certainly said the signals. I think the other thing you make a point about China is, there is pivots. There's the China Plus strategy in India. India is now benefiting from potential foreign capital coming in as a pivot against China, or at least a balance against China, not to get out of China, but to maybe rebalance. This is true for Vietnam. Indonesia's economy doing well. So, I think if you're chasing foreign capital, and foreign capital is not as confident in China, it's going to find plenty of places to go. And I think that's probably maybe in all the maths around why the underperformance of Hong Kong and Chinese equities, maybe that as well, is that the demand, the appetite for foreign capital to come in is less because the alternatives are better.
And of course, the other theme is this big surge in AI-related stocks around the world, which is presumably one of the reasons why South Korea and Taiwan are both performing, because they've got leading chip makers there. But also in the US, we've seen NVIDIA. It's almost worth $1 trillion now. Is this a frenzy? Or is this something that is really, there is a real change going on in the tech industry that's justifying this sort of euphoria?
Well, I don't know, to be brutally honest, whether that's in fact the case. But clearly, I think the Nasdaq was up 6% in May, mainly driven by this AI tech boom and the new growth story, if you will. The established growth stories around the Amazons and Facebooks, etc. They've moved on now to the new tech. So maybe we are seeing another, another drive on in that type of growth stock in AI. So don't know enough to be able to give you a good call on it, but certainly watching it closely.
Toby, thank you very much indeed, and have a great weekend. That's Toby Lawson, who is director at Statton Advice. Thank you for listening this morning and this week. Don't forget to take a look at my daily newsletter, which is at peterlewismoneytalk.substack.com. I'll have more business and finance updates for you on Monday. Joining me then are Alex Wong, Director at Alex KY Wong Asset Management, and David Friedland, Managing Director of Asia Pacific at Interactive Brokers. Have a great weekend.
Money Talk